There are many different types of investment instruments, and unit investment trust funds, or UITFs, came into the local market at the turn of the century. Today, we'll talk about the risks and rewards of investing in UITFs and how they compare to other investment instruments. I'm Edric Mendoza, and this is On the Money. Joining us in this episode is Christmas Sevilla, Vice President for Wealth and Management at the Bank of the Philippine Islands. Hi, Christmas.
Hi, Edric.
Very unique name you shared because you were actually born on Christmas Day. Welcome to the show.
Thank you very much.
Yeah, so let's talk about UITFs.
Okay.
Let's start off by maybe, especially for our viewers, what does UITF mean?
Okay.
What is it?
Maybe I'll just give the technical definition.
Sure.
It's an open-end pooled trust funds that allow clients to or investors to participate in a pool of fund by buying units of that particular fund.
Right. Okay. So similar to a mutual fund, right?
It is similar to a mutual fund,
right?
except that one is a share, this one is a unit of participation.
Okay. Tell me how it differs from other types of funds or other types of investment tools, rather.
Okay. Maybe we can start with a time deposit.
Sure.
Okay. Unlike a time deposit, UITFs or investment funds do not have maturities. Okay. The returns are not guaranteed, and there's no PDIC.
Okay.
There's no insurance.
No coverage, right?
Yes.
Right. If it gets lost, that's the risk, right?
So that's the general differentiation between a
time deposit, for example, and a UITF. Okay. So other instruments, how would compare to, let's say, what others would you be able to compare
we can also compare it with SDAs.
SDAs.
Well, in the same manner, they actually work like a time deposit also. So a UITF also does not have, an SDA has a maturity. So UITF does not have one. So when you buy shares, when you buy units, you hold on to that, and only at the point when you wanna sell it will you go to the bank and sell it.
I see.
But an SDA has a maturity, so it has a term, 30 days. The rates are fixed.
Also, and guaranteed?
And guaranteed, yes. UITFs do not have a fixed rate.
Right.
So we can only quote historical returns.
Correct. Now, historically, the UITFs compared to a time deposit, or let's say even to a SDA, how are they performing historically?
There were times when, initially when it was offered, when the rates were really very high, that it was really better than a UITF. And even at this...
Sorry, the SDAs were better than... Okay.
Yes, the SDAs were better than the
UITFs.
Yes. But right now, a money market fund are actually doing better than an SDA.
Okay. A money market UITF.
UITF,
right.
yes.
So let's talk about the different types of UITF. So you mentioned money market. What else are there?
Actually, money market is part of what we call the fixed income funds.
Sure.
So we have fixed income, and then we have equity funds, and then we also have balance funds.
Okay.
Now, under the fixed income, we have two types. So you have the money market fund, which are fixed income funds invested in short-term instruments.
Okay.
And then you have what we call the bond funds, which are invested in securities more than 1 year. So, and then you have balance funds, which is actually a mix of equities and fixed income. I call it the two-in-one, so like the coffee.
Yeah.
So you have both.
Yes,
you have both in one fund.
Right.
And then you also have the equity
fund. I like
fund.
that, a two-in-one coffee. I caught that. Okay, yeah.
And then you have the equity fund, which is invested in stocks.
Right. And naturally, I mean, the risk involved and the returns involved follow that same progression.
Yes, so you have the money market, you have the bonds, you have the balance, and then you have the equity funds.
Excellent. So I think the next natural question is, how does that compare to a mutual fund, which has the same classifications, right?
Yes. Yeah. Generally, they're actually the same. They're both investment funds. They also work in the same manner, in that you buy. In the case of mutual fund, you buy shares because you invest in the company. So you buy shares of that company.
Very clear.
Yes. For a UITF, you buy units. But in general, they work the same way. You give your money to the fund manager, they get that money and they invest.
In those types of funds which we talked about earlier, right? So if a person was to choose between, let's say, a mutual fund and a UITF, you were saying earlier that maybe one consideration would be the holding periods.
Yes.
Whereas in a mutual fund, would you like to expound on that? Yeah.
Well, there are some banks with who have UITFs that have holding period, and then there are also banks that do not have holding period.
Okay, so that would be one advantage of UITF versus a mutual fund, for example, right?
Yes.
Right.
Let's say, for example, if you're investing in an equity fund, you can actually go in and out without worrying
Sure.
about
The holding periods, etc.
period.
Okay,
Yes.
management fees wise, they're pretty much
the same.
the same.
Yes,
Okay.
both have management fees.
Okay, so what are the pros and cons of UITFs versus the other types of options? So we've already talked about versus mutual funds. Other options, what would be the pros and maybe even cons that people need to consider?
Well, as I mentioned earlier, when you invest in a UITF, I think it's basically that there's no guarantee in terms of returns, that we cannot, there's no PDIC. But in terms of the cons, one of the advantage of investing in a UITF is that when you invest in a single security, let's say for example you have 100,000, when you buy one security, that's 100,000. You can only buy, let's say, treasury bill, and that's where your 100,000 will go. But when you buy a UITF, let's say for 10,000 pesos, it's like investing in 20, 30, 40 different securities. So what does that do to an investor? Number one, it allows you, yes, it allows you diversification, and it allows you to get better returns from your investment, because you're not just invested in one security, but several securities.
Right. So question would be, if a person, so you're saying UITFs are offered by banks, right? How would a person decide which one makes most sense? Or would they offer pretty much the same end return, etc.? You
will have to look at the investment objective of these different funds, because they have their own, even if they're, let's say for example, they're both money market funds or they're both bond funds.
Right.
One, let's say for example, can invest in purely government securities, and the other one can invest in government securities plus corporate securities.
Right.
So one is more diversified, the other is not.
I see.
So
And Christmas, a person could actually just ask the bank that and say, hey, you know, banker A, can you tell me what are the investment objectives of this in your bank? So that they can do that.
Yes,
so they would understand. No?
Yes, because it will actually help if a client who's interested to invest in a UITF would go to a bank and ask for what we call the fund performance report.
Excellent.
Because that will tell you everything. Where the fund is invested, how long, what are the historical returns.
Right.
So it will allow you to know more about the fund, and you can go to investing with a really full knowledge on what you're investing into.
Excellent. And by seeing that, you'll also see the objective. No, parang,
yes.
So this is what they're doing, therefore, this is their objective. Excellent, excellent. So for a person who wants to now do that, what sort of cost is involved? How much to start a UITF? Is there a minimum, monthly, etc.?
Okay. The minimums right now for UITFs vary, but it can range from 5,000 to 10,000.
To start investing?
To start.
Oh, it's fairly low, no?
Yes,
I mean,
exactly.
Okay.
So a retail investor or someone who's just starting can really go and open a UITF.
Yeah, even a college student, I mean, at least 18, right? To be able to set these things up?
Yes.
Okay.
So you can go to any bank and open a UITF. But what is very critical, I think, is unlike an SDA or let's say time deposit, when you just go to a bank and say, I want to open time deposit. When you want to invest in a UITF, you have to go through what we call a risk profiling.
Sure.
Because it's very important to find out whether you are risk averse or whether you are a risk taker.
Yeah.
Because as I mentioned earlier, there are different types of UITFs.
Different objectives and different personalities.
And it can be as risky as an equity or moderately conservative in terms of risk.
For the balance funds.
For the bond funds, for the money market funds.
Okay, excellent. Would you say there's a personality type or a profile that actually fits UITF investing?
Yes.
Okay.
Definitely, conservative investors cannot invest in UITF.
Cannot. Okay.
Cannot.
Okay. Would you say that a person who's putting money into UITF must be looking long term as well, or short term? Is that a factor?
It can. If you're investing in equities, you should have a long term investment outlook. But let's say your objective is, let's say for example, you wanna travel in 1 year.
Yeah.
so it's a very short-term
Right.
objective, and you want to save money or save money and invest it, then you can also go to a money market fund, because that sorts of matches your short-term horizon
Understood.
with your short-term investment.
Right. So horizon is not necessarily a factor. It's just which one of the UITFs to choose. But the risk is clearly a factor, as you were
Yes.
saying. Excellent.
Investment horizon is also a factor,
Yeah.
but it's not as critical as
the risk.
The risk,
Appetite.
Yes.
Okay. We're going to have more questions for you, Christmas.
Okay.
But right now, we're going to have to take a break. So stay tuned. On the Money, we'll be right back. Welcome back to On the Money. Time now for our daily dose of Salve Says with Salve Duplito.
Remember those days when your pandesal was like this, plump and filling? These days, your pandesal will probably be like this. Or your 1 peso pandesal before now cost 5 pesos. That means you have been bitten by inflation.
Inflation is not as alarming as a stock market crash, but it eats up your money more effectively in the long run, just like a termite would eat your house. It reduces your purchasing power. That's why the same amount of money you paid Aling Weng for pandesal will only buy you a small one now. It also affects the profits of companies that you might own through shares bought in the stock market. Another way it could hurt you is by affecting your income from investments like treasury bills and bonds.
Inflation went as high as 50% in 1984, a few years before the EDSA revolution.
From 1973 to 2008, the average inflation is 11.1%. You know, in most advanced countries, the average is 2 to 3%. Because of the high average inflation in the Philippines, your 24 pesos in 1972 has a value of only, wait for it, 65 centavos today. This average annual inflation means the value of your portfolio is cut in half every 10 years or so.
If I just put my money in a sack and hid it in the basement under cement, thieves won't get to it, but inflation will. This is why conservative investing, particularly in the Philippines, will not work. Nor will a short-term view towards investments like putting money in a stock just because of a hot tip.
Historically, experts say stocks and commodities like gold and other metals or oil are the ones that can temper the effects of inflation on your money. The problem with commodities is that they have no intrinsic value compared with shares of companies, which are assumed to report profits over time. Bonds are most sensitive to inflation. While your principal and interest is guaranteed, the purchasing power of your earnings is sure to go down as well.
The only way for this to change is for inflation to keep going down as they have been since 2009. So, create the long-term view and create a mix of investments with this silent killer in mind.
Still with us is Christmas Sevilla, Vice President for Wealth Management at BPI. She will answer some of the money questions you sent us via email, Twitter, and Facebook. Mel, what questions do we have for Christmas today?
Christmas, our first question comes from John via email. He asks, how do I know if a UITF is right for me? What will it cost to invest in one, and what is the minimum amount of time I should keep it for? I think you discussed some of this as well.
The minimum amount of time is a good question to ask.
Yes.
Yeah, that's
it depends on your objective.
good.
If, let's say, as I mentioned earlier, if your objective is to, let's say, travel in the next year, then your investment horizon is 1 year.
Right.
Then you should not be investing it in equities.
Correct.
You should invest it in something shorter.
Money market.
Or maybe a bond fund. But if your objective is really for long term, let's say, for example, a retirement, and you're like in your 20s or in your early 30s, then you should invest in equities to take advantage of better returns.
Okay. How long, what's the minimum amount of time you would want to stay invested in equities?
At least 5 years.
Okay.
At least 5 years. So
Okay.
that's
Great.
the
It's really
ideal.
long, right? You really want
Yes,
to ride it
it's
out.
really
yeah.
a long-term investment.
It goes fast.
Yes, the 5 years.
Yeah,
But the
5 years.
mindset is minimum 5, but you really want to keep it as long as you
Yeah,
can,
you
right?
Yes,
Diba?
exactly,
You want to keep it
exactly.
there. 5 is just the minimum, but keep it there.
Yes.
And you can always take out from it and then leave the
Yeah.
rest rolling, right?
Exactly.
Excellent, yeah.
So
But
if
after
you need
5
money,
years,
you can
yeah.
withdraw. You can redeem, and then you can subscribe again.
Okay,
Excellent.
great. Okay, we have another question, and this comes from Frank via email. What's the benefit of investing in mutual funds and UITFs if returns are not guaranteed? And can you even lose money? If it's not even insured, why risk it?
Okay, that's a very nice.
Challenging, good,
That's
good.
a very nice question.
Yeah.
Well, actually, you have to look at it this way. When you go to, let's say, for example, if you want to put your money in a time deposit, there's no risk. I mean, you know what you will.
Seemingly, yeah.
Yes, you know what you will get at the end of the term. But when you go into a UITF, there is no guarantee because there is that potential for better returns.
Right.
So, in terms of you're taking the risk, and in exchange for that risk, you should be getting better returns.
Right.
So that's the
Yeah,
give and
that's
take
the-
there.
that's
The
the
risk
payback.
and the
That's the
return.
factor that you have to
Yes.
consider.
Now,
Okay.
back in 2006, things kind of crashed because there were so many redemptions.
Yes.
Are there safeguards today against that type of thing happening again?
Yes, I think one of the offshoot of the 2006 UITF crisis is that we are now more stringent in terms of ensuring that when a client invests in a UITF, he really knows what he's getting into. That there's really the possibility that he can lose money if, let's say, he needs the money right now and the prices are down and he decides to redeem.
Right.
So it's really finding out at the onset whether this product is really perfect for you, whether you should be investing in equities or a money market fund, because you may want to invest in a equity UITF, but if you see the downturn and you get scared, then obviously it's not the one for you.
Right.
Right.
I mean, maybe for perspective, what caused the surge in redemption back in 06?
Interest rates really went up
I see.
at that point.
So it just came
yeah.
all at the same
panicked.
time.
Yeah, people
Right.
panicked because
Right.
they saw the prices going down.
And I think it wasn't explained to them enough.
Yes.
What they were getting into
Right.
when they first signed up for a UITF, right?
That's what became a
And
crisis.
Because
So-
at that time, the returns provided by the UITFs were ranging double digits,
Wow,
12,
so it was
13,
very
14.
attractive.
So sometimes people were just going into it because of the
I
returns.
understand.
So, and they really are not, they really do not know what they're getting into.
Excellent.
Okay, we have another question, and this comes from Zaldi via Facebook. He says, I work here in Dubai. How can I invest in UITFs there?
Or
I mean,
here in Dubai, yeah,
the
he's saying.
Philippines. Why doesn't
Oh,
he
they're
do
meaning
it-
in the Philippines?
Yeah, he means
Okay.
here in the Philippines, although shouldn't he consider
Maybe we can answer both.
UITFs in
Can he do
Dubai?
that abroad? Can he do it here, right?
He cannot.
He cannot do abroad.
He cannot do abroad.
Okay.
But if he opens an account before he goes abroad, if he
Oh.
opens an investment, then he can look
Process the papers,
yeah,
etc.
view it in the internet, do the transactions online.
So when he visits here, he could open
A UITF.
a
UITF.
UITF here
Yes.
and then leave, and that's
Yes.
okay.
Or he
when
can,
he's visiting.
or he can instruct his beneficiary
I
or
see.
family here
To do the
to,
same.
but they will have to open the account for him.
Right.
Can he also, would you recommend that he invest in UITFs that are available in Dubai?
If there are something similar to UITFs, then yeah, he should be investing his money. Because I think the most important thing is he's earning money at that point, and he should be saving or investing for the future.
Right.
Because you don't want to reach that point that when he comes back to the Philippines, he doesn't have any money.
Right.
Yeah, that's right.
So Christmas UITFs are not necessarily available globally. There might be, you said, in Dubai.
UITFs are there are actually some collective collective investment schemes all over, like
I
in
see.
Singapore.
Maybe just a different name, for
yes,
example.
Singapore,
I see.
Malaysia,
Okay.
Hong Kong.
Okay.
But it's worth taking the opportunity if you're already living elsewhere to look at what financial
explore,
products
yeah.
they
Yes,
have.
definitely.
Yeah. Thanks, Christmas. Anyway, send us your money questions via email, Twitter, or Facebook, and we'll try to answer them in our upcoming episodes or on our next Q&A Friday.
Right. So moderately risky, type of personality, or moderately conservative, right?
Moderately
You're saying?
conservative.
The UITFs suit those type of personalities. Excellent. But do your research.
Yes.
Find out the data before you actually get into it. That's our show today. I'm Edric Mendoza. Join us again tomorrow for more talk and tips so you're always right on the money.